Good afternoon and welcome to this ACT webinar on the renminbi, Embracing the New Norm. I'm Michelle Price, Associate Policy and Technical Director here at the ACT. To explain the technical points about our webinar setup, there is a menu bar across the bottom that allows you to open various windows, and you can move these around your screen, resize them or minimize them. The green button with a question mark on it down there is for help if you have any technical difficulties. And another button there opens the Q&A window. You can send in questions by typing in that Q&A window. Don't wait until the end to send in your questions. Just send them in as they occur, and we will deal with them at the end of the presentations. Our practice is that we don't disclose any names. I should add that a recording of this webinar will be available on the ACT website within 2 days, along with a separate copy of all the slides. Over the past 2 years, the renminbi has come a long way, both in terms of its usage amongst corporate treasurers and deregulation. The pace of regulatory transformation is fast, and I personally have found it very difficult keeping abreast of the changes. Last year, in 2014, in the Treasury magazine, we had 19 articles referring to the renminbi, and in recent months I've attended many conferences where the renminbi was a key topic on the agenda. It certainly is flavour of the month. In this webinar, we will have a presentation on renminbi internationalisation by Louis Sun, Head of Sales, Global Payments and Cash Management at HSBC China. Louis is going to talk us through both the recent regulatory changes and the rapid growth in usage of the renminbi. HSBC needs little introduction. They are one of the world's largest banks and have had a continuous presence in mainland China for nearly 150 years. They are also the sponsors of this webinar, so we thank them for that and for providing Louis's expertise today. This will be followed by a case study illustrating the corporate's perspective by Julian Tasker, Group Treasurer, Johnson Matthey. We will then finish with the discussion and as many of your questions as we can get through. So let's get started with Louis.
Thank you, Michelle. It's my great pleasure to participate into this ACT webinar. I think the RMB internationalization is a very, very big and broad topic. It covers, a lot of different aspects, including, using RMB for the trade settlement, using RMB for investment and also, potential hedging. And certainly, I guess the biggest implication for the, treasury specialist is what's in it for all the corporate treasurers, especially surrounding, risk management, liquidity management. So my session today will mainly focusing on the implication from, the RMB internationalization developments on, corporate, treasury management, especially surrounding the liquidity management part. What are the new regulations being announced by, the monetary, the central bank in China? What are the potential structure can be deployed by the, corporates, which, couldn't be done in the past. I may start my session with a bit of explanation on the China's approach to a regulatory reform. I'm sure all of you have seen a lot of developments in China surrounding different new regulations issued, and many times you may feel a little bit of ambiguity about the newly announced released regulation. Sometimes you find although the overall direction is quite promising, but the operational details can constantly be a challenge to deal with. So I guess the reason behind that, China is undergoing a really sort of significant change on the the overall the regulatory environment. For China, such a big country, it's very, very difficult to maneuver the whole process because there's not so much precedence to refer to. Therefore, our great leader Deng Xiaoping ever mentioned, right now for China is at a stage of we're crossing the river by filling the stones underneath. So basically, we need to figure out a road how to do the regulatory reform. That's the reason you see a lot of developments more like a new policy, new scheme at first stage just to test water, to say whether it works, what are the risks associated to this kind of developments. Second thing is, although it's challenging to have a very optimal, balanced way to drive for the regulatory reform in China because of the large geographic coverage or quite imbalanced economic situation across the whole country. But we found regulators are very determined to make small steps over time. So essentially following the so-called spiritual directions of all the regulations, eventually regulators want to achieve the big agenda to open up the financial market. From our big leader, the key point President Xi Jinping mentioned recently is really a lot of pilot schemes, a lot of new policies being announced in the past 1-2 years, essentially will be rolled out across China, especially a hot topic of the Shanghai free trade zone. That concept was made very clear to be a pilot zone. Eventually, all the new policies being pilot in that zone will be rolled out for the whole China. So this is just to give you a bit of flavor on how China is going to do this regulatory reform. Okay. Specifically on the deregulation part, surrounding RMB, we have seen a lot of developments. I guess most fundamentally, we have seen is really the developments on the two liberalization. One is exchange rate liberalization. The trading band has been widened to up and down 2%. Normally that's more than enough for traders to trade within the same day. And the interest rate liberalization has been done in the past 2 years. In July 2013, the bottom rate of lending has been removed. So right now it's really commercial, completely commercial driven for the lending rate. On the deposit side, November last year, the cap of the corporate deposit was further lifted to be a 20% markup from the PBOC base rate. So it's very, very symbolic. And people are speculating when this credit interest rate might be fully liberalized. I think early indicator might be when China is going to implement the deposit insurance scheme, because essentially government still wants to protect the consumers from the risk. So I guess once we say the launch of the deposit insurance scheme, then the full liberalization on the interest rate will come very soon. Also on the RMB, internationalization, there are a lot of developments. I guess one very symbolic and I would say a milestone was a regulation announced in July 2013. In that regulation, essentially PBOC allows corporates to lend your excess cash from China to overseas. I think we can say starting from that point, this excess liquidity, or sometimes being called as a trapped cash, is no longer a valid concept. Okay, because as long as you can evidence this is a cash generated from your normal operations in China, you can very much freely lend the cash from China to overseas. You don't need approval. You can just go to a bank. The bank will do some due diligence to make sure this is the cash generated from the investment opportunities or divestiture of some business, or even or the operational cash flow. Then you can lend without a hard limit from China to overseas. Okay, Shanghai Free Trade Zone is another interesting development. Basically, it's a much bigger topic than just RMB internationalization or finance reform related. It covers many other aspects. But I guess for our treasury developments, Shanghai Free Trade Zone also started to allow a real RMB two-way cross-border cash concentration or cross-border sweeping. When I say two-way, the difference as compared to the one-way lending from China to overseas, as mainly two-way allows company to borrow, funding from overseas via the intercompany loan, intercompany structure to finance their expansion in China. So the big benefit for corporate under that new policy is they will be able to tap into the cheap funding market overseas. To finance their China expansion in RMB. Okay, last year actually the central government further enlarged the free trade zone to a few more cities. So right now, officially, we have 4 free trade zones in China. Some of the policies launched in Shanghai free trade zone might very likely be expanded, but we need to wait for the timeline. Not necessarily on day one, those policies will be replicated, because once the Shanghai free trade zone policy is being tested, when the central government, central banks feeling comfortable about the development, they may replicate. Okay, these are basically the developments. I think before we move on to treasury implication, I guess I also want to mention a little bit of the RMB developments. Actually, just last week, if you look at this slide, right, RMB right now ranked number 7. Actually, not right now. Actually, October last year ranked number 7 in terms of the value used in the national trade. But actually, last week, SWIFT issued the latest statistics. Basically, RMB ranked number 5. This is how quickly RMB is developing. I think the key reason behind this is that China is a big trading country. So if significant portion, right now we're talking about 25% of the cross-border trade in China are settled in RMB. That itself is already a big amount. Second point I want to mention is that you look at the RMB liquidity on the offshore market, it's growing very significantly over the past 3-4 years. Especially for last year, I guess the biggest observation we had is really in the past there was always a theory the amount of liquidity on the overseas market was strongly correlated to the appreciation speed of RMB. But last year, essentially, RMB against US dollar depreciated. However, the RMB liquidity still growing very strongly. I think yesterday, or I think last Friday, Hong Kong announced, the liquidity, position in Hong Kong grew by another 3% month on month to be above 1 trillion RMB in Hong Kong. Very significant growth. Under the backdrop, RMB against dollars actually is depreciating. I also highlight one last point on this slide is if you look at the liquidity position in London, okay, I think June 2013, that was a 3.1 billion. The number is small, but after a year, in July 2014, literally after just a year, that amount from 3.1 billion grew to 25.6 billion. This is how fast the London hub, the London RMB settlement center is growing. Okay, I think it's actually a good news for. I specifically highlight this point because we're having this seminar in London. So from a treasury practice point of view, I think as a cash management specialist, we're feeling very excited because in the past, I guess if we talk about cash management in China 5-6 years ago, the approach is normally let's discuss the rest of the world before we move to China because China is always was always isolated. But right now things are changing. I think from a few key process parts, right? The first one is the cross-border liquidity management. In the past, trapped cash, access liquidity was a challenge, and the company could only do domestic cash pooling to just for the onshore intercompany financing, and even for financing investing options very, very limited. Now with this kind of a new development on the cross-border, this kind of new policies, essentially, I think trapped cash should no longer be a concern because after the policy issued in July 2013, company can lend excess cash from China to overseas, pay down the debt at head office. I highlight two different points: one-way cross-border sweeping and two-way sweeping. Difference between one-way and two-way, just to clarify a little bit. One-way refers to the sweeping structure is fully automated, back and forth. Okay, nothing different from the standard sweeping structure used in any other country. But when we say one-way, that means the net position from onshore to offshore is always positive. Essentially, the legal framework is riding on the cross-border lending, but just we use system to automate the lending out and repayment. However, two-way sweeping is one step further. The net position can be also negative, meaning essentially corporate can use a sweeping structure to tap into the cheap funding market to finance their expansion in China, and that process can be fully automated. Second point is on the settlement part. I know the concept of payment factory is quite popular in many of the European countries, including UK, Germany, that kind of countries. But payment factory has been sort of a challenging concept to be adopted in China, because in the past for cross-border transactions, the settlement principle is money flow follows goods flow. If company A is buying from company X from overseas, company A must pay directly to company X in the overseas, as evidenced by the supporting documents. You can't let a treasury center to settle on behalf of company A with company X, but that's changing. SAFE allows both state administration on foreign exchange and PBOC. Right now they allow this pay on behalf of, receive on behalf of, for cross-border transactions. For RMB, that has been sort of made very clear to corporates. One step further is supporting documents are still required. However, in some of the operations, they are also willing to accept the paperless automation for cross-border transactions. Okay. One last piece is on the free FX trading for traders. They don't want have any limitation to trade currency when they need to do. But for this part, you may find the only question mark I put it here, right? Ideally, corporate traders wants to do conversion on willingness basis. Whenever I say the market's in my favor, I do the trading. But the principle in China still conversion on need basis. Need means you have a legitimate need of trading or capital investment, evidenced by the supporting document. Then you are allowed to trade. Right now, this is still a question mark. So principle doesn't change. Only as a symbolic move. For capital injection into China, corporates can do conversion on willingness basis. You can convert anytime you want to do it under two conditions. One, the proceeds of the conversion must be kept into a special account. And when you need to use the proceeds, you show the supporting document to the bank. Second thing is you can convert from foreign currency into RMB, but you cannot convert RMB back to foreign currency to avoid just the trade on the market. Okay. So I'm going to give some examples on the implication to corporate treasurers. Essentially, in the Shanghai Free Trade Zone, since its launch in March last year, when the operational details are in place, right, the two-way cross-border sweeping can be done. If you look at the structure here, essentially this is a client that actually is in need of cash in China. So they connect their domestic structure with a regional RMB account via an entity in the Shanghai Free Trade Zone, so that when they need money in China, they can borrow actually from the same nature account in Hong Kong to finance their expansion in China. And what the prerequisite for this is basically they need to have a presence in a legal entity in the Shanghai Free Trade Zone to be able to enjoy this policy. From a system point of view, this is a standard cross-border sweeping structure. Between the master account in China and the subsidiaries, sub-account in Hong Kong, this is a fully automate end of the sweeping from Hong Kong into China. Okay, certainly the benefit for this client is when they're cash rich in China, they can withdraw cash from the Hong Kong sub-account to pay down the head office debt. But when they're in need of cash, they can simply finance the sub-account in Hong Kong. Then the money will be swept into the header account in China automatically. So this was the regulation announced in Shanghai Free Trade Zone, and the market was very excited about that. And now, this policy has been extended to nationwide, but with a bit more restrictions. On this page, I give a bit of a comparison on the nationwide policies versus the Shanghai Free Trade Zone policies. A few key difference. There's an eligibility requirement for nationwide policy, essentially the size of the company, onshore sales revenue above RMB 5 billion, offshore revenue above 1 billion. And all the participants must be established for at least 3 years under this nationwide policy. Or in the Shanghai Free Trade Zone, there's no such requirement as long as you have a presence. The second thing is on how much you can borrow from overseas into China. How much you can lend out. Same. Okay, you can lend out as much as you want, as long as you evidence that's cash generated from the operations. But how much you can borrow from overseas into China? For the nationwide policy, there's a 10% of the total equity cap where in the Shanghai free trade zone, there's no hard cap. However, you need to evidence the financing from overseas into China are for working capital use. Okay? And the other, minor things is for the nationwide policy, there is a filing process, very formal filing process. The bank needs to send a document on behalf of the corporate for the corporate side before we can implement this, where free trade zone is purely a discussion between the bank and the corporate side. And on the nationwide policies, it's literally just one bank. Okay, just to conclude, basically, this nationwide policy, we still see restrictions, and it's very likely the government may gradually open up. But from what we have observed on the market, we see a very, very strong interest for clients to take up this kind of a new policy. So I may pass it over to Julian to share live experience on how to, tap into this new policy to establish the live structure. Okay, over to you.
Thank you, Lewis. Thank you, and good afternoon, everybody. So I'm just going to take an opportunity here to sort of talk you through our approach in Johnson Matthey to treasury management in China, and then I'm going to just talk through what we've done, particular focus on what we've done in the past 2 months. So my first introduction was just a little bit of background to Johnson Matthey. We're a specialty chemicals company, world leader in sustainable technologies. We focus on clean air, clean energy, and we're experts in the application and recycling of precious metals. We're almost 200 years old, and we're currently the 61st largest company listed on the London Stock Exchange. Top line revenue, as it says there, of 11 billion, and underlying profit of 427 million. We're in over 30 countries, and we have a leading position in most of our businesses, and most of the markets we operate are ones where there are only a few companies. So just before we go into the detail on the treasury activity, a bit of scene setting for China. Our business in China, we've just this last month celebrated 15 years on the ground with assets constructed in China. We started off with just 2 legal entities, and now we have 17 legal entities covering 24 business units, spread quite a bit around China in about 9 locations, but concentrated predominantly in Shanghai and Beijing. Our top line revenue in China is £540 million, but actually this is kind of distorted by precious metal prices. So China roughly is about 11% of our group sales, excluding precious metals. As it says here, we have about £250 million of assets and just over 830 employees, although I'm sure that's out of date already. So what's our approach to treasury management, and particular thinking about how this applies to managing treasury in China? Well, we have a centralized approach, like a lot of companies. We have a group treasury team in London. Point out at this point, we do not have any specific treasury resource on the ground in Asia, so we manage all of this out of the London team. We borrow centrally using the group's credit position to fund in the most attractive markets at any particular time, and we will lend on an intercompany basis to our units, including in China. Another key thing for us is to keep things simple at the business unit level. So in China, for example, we try and do everything in renminbi and manage all the complexity in the group treasury function, where we're set up to do that. We do leverage banks who provide a commitment to the group, but this works 2 ways really, because in selecting those banks, we need a balance of banks who have the expertise on the ground and the necessary local presence to meet our requirements in the various markets we operate in, including China. We automate cash management wherever we can, just for efficiency. And I suppose the unusual thing about Johnson Matthey is we have very large short-term fluctuations in our cash position. driven by our working capital and the impact of precious metal prices on that. So we need to be able to move and manage very quickly between borrowing and depositing positions, both in legal entity and in country. And it goes without saying, but all of this needs to be supported by a strong control and reporting framework. In certain instances, we do need to have some local facilities, and so it's important for us to have the framework that we can maintain the control of those centrally. Right, so turning to what we've actually done in China. Well, I said earlier, we established ourselves, our first presence on the ground in 2000, and for a very long time we operated with just two small standalone businesses. As our businesses grew and the market started developing, we started developing treasury structures to meet our approach that I've just talked you through. The first of these was in May 2011, where we set up a RMB domestic cash pool for our then 6 legal entities. And the primary reason for this was, at that time, some of those businesses were still in the start-up phase, so were borrowing, whereas two of them clearly had been there for over 10 years and so had cash. So it was an efficient way for us to move that cash between those cash-rich entities and those who required funding. Then, following the creation of the offshore renminbi, the CNH as we know it now, in 2010, it wasn't actually that long ago, believe it or not, less than 5 years, we opened an offshore RMB account in Hong Kong, which we used initially just to utilize for intercompany transactions between China and Hong Kong. We have some significant intercompany transactions that go between those two entities. And in the early days, there were often significant arbitrage opportunities between the onshore and the offshore rate. So we were able to change our currency of invoicing to take advantage of those situations. The following year, we funded a significant expansion of our emission control technology business based in Shanghai, and we did this with an RMB denominated shareholder loan, and we hedged this in the offshore market using cross-currency swap, dealt with our panel of dealing banks based in London, but I think it's fair to say a number of them were accessing their teams in Hong Kong. And in November 2012, we decided to consolidate our liquidity, starting with our Hong Kong entities, into a cross-currency notional pool based in Hong Kong. And last year, we made our first registered capital injections, our equity component of any investment. We did that in RMB rather than US dollars that we had previously done. And here today to kind of talk to you about is what we've just going live with or gone live with today, which is our automated two-way sweep between our domestic renminbi cash pool and our offshore cash pool, which we have in Hong Kong. Just to talk you through what that structure looks like, on this chart, you can see, starting at the bottom, we have our domestic cash pool, and everything I'm talking about here that's highlighted is renminbi. This is actually now for 10 legal entities. So the reason it's not all of our legal entities in China is around some of the parameters that are currently in place for doing this structure. And one of those is that any participating entity must have been incorporated for at least 3 years. So although we have 17 legal entities, a number of those have been incorporated relatively recently, so are not able to join this arrangement. So these entities sweep into a header account, which is as we've been doing for almost 5 years now, and that header account that header entity has had to open a special cross-border sweeping account, which is the top purple box on the chart. And this is really just to facilitate the recording of these cross-border transactions. So whatever happens with the net position in the domestic pool is transferred to or from this special account, which again is held by our Shanghai entity, which is the cash pool header. And then on a daily basis, at the end of the day, that balance sweeps to or from an account that we, as Johnson Matthey plc, the top co, hold in Hong Kong. And that account is, again, CNH denominated. Couple of other things just to sort of talk around this. Conscious of one of Lewis's slides earlier, but we're not in the Shanghai Free Trade Zone. So this is outside of that arrangement. We manage these funding on a daily basis, and we manage it out of London, utilizing forecasts from the underlying businesses in China, and then we will fund or defund the net cash pool in Hong Kong. And one of the things to point out with this is that we don't have to fund this position through CNH on any given day because it is a cross-currency notional pool. So we do have the flexibility to avail ourselves of other currencies that may have more favorable cut-offs like the US dollar. The other point just to note really is there are some parameters around these cross-border sweeps. I think Lewis touched on it earlier. The sweep from offshore into China is limited to 10% of the onshore equity. And there are parameters that we have to put in place in terms of the amount that can be swept out of China, but that's largely around what we can demonstrate from our cash flows rather than any hard mandated limits. And so with that, I will conclude, and I guess we move to questions.
Thank you very much, Julian. I mean, it sounds like you've done quite a lot in renminbi cash management in what is really a short space of time. The first question that has come through, and I'll direct this one at Lewis, if I may. Does this really mean the end of trapped cash in China?
I think the regulation issued in July 2013 gave a very, very clear signal. Basically, for corporates generally operational cash in China, government allows corporates to lend access cash from China to overseas. What we observed on the market is right after that regulation, some corporates started to do some cross-border transactions to ensure that that's indeed true. And once they finish the pilot transactions, in fact, they're no longer so keen or rush to do more cross-border transactions because this regulation is very unlikely to fall back.
So they were just testing the water.
That's right, and to say the process. When the documentation is ready, then next time it will be just a few days turnaround time to withdraw liquidity from China to overseas. In fact, I heard from some group traders, actually they just demonstrate this regulation to their credit rating agency to evidence my cash in China is no longer trapped. Don't apply the haircut for my cash in China. In the past, when cash was trapped, there will be a quite significant haircut for the liquidity position when the credit rating agency calculate the liquidity ratio, but it's no longer the case after this new regulation being announced. So it's very symbolic.
Okay, thank you. Julian, I think this one's probably for you. This one's overall regulations are one thing, but locally requirements seem to vary according to who you were talking to. Have you found that?
Yes. Yeah. I mean, I guess we're undoubtedly lucky here in that most of this is centralized in Shanghai, which is well known as being the sort of most forward-looking, or at least the easiest areas to operate within China. But having said that, the participants in the cash pool are from all around China. We have Beijing, Qingdao, various other places across the country. I think, as always, it's important to get canvas opinions from different parties. But what I would encourage treasurers to do is to actively challenge some of those parameters that people are putting at them, because often actually the banks have the ability to go to the local PBOC office or safe office, describe to them what they're trying to do, and in the context of what Lewis said of China actively trying to open up some of these markets, they can actually do things that initially they may say, no, you can't do. And a number of examples from local funding type of operations to basics like how many bank accounts do you need on the ground? Do you need a separate bank account for your tax payments, for your capital account, your shareholder loan account? A lot of those things actually, if you push hard, you can get more streamlined answer.
And when you're saying get different opinions, are you meaning from different banks? Or
yes.
Yeah. Okay. I think this one's also probably another one for you, Julian. You did mention the limits and on your cross-border two-way sweeps. How do you actually manage those? Is the question. Given you've just started today, maybe.
Absolutely.
It's a little bit early, that question.
Well, I mean,
how will you manage those?
How will we manage those? Absolutely. So, firstly, we've got an overdraft facility attached to our Hong Kong cash pool. So I talked earlier about Johnson Matthey. We have very large day-to-day volatility in our cash flows, so we need to have some sort of more local facilities to manage that. So those parameters I talked about fit within the parameters that we apply to the overall cash pool in Hong Kong. And actually, when we set those parameters, we actually looked at, well, what were our cash requirements on the business. We've gone back and looked at the data for the cash pool for the past 12 months, and we've looked at our internal projections, and that's how we made our case that was taken to PBOC for those limits to be appropriate.
Okay, great. Lewis, there's a few of these questions coming in on how long would it take to set up cross-border sweeping. So quite a few people are interested in the time.
I think if you look at the live case of Johnson Matthey, it was roughly less than 3 month practice. Having said that, I would say there are also a number of key dependencies. One is whether domestic overseas structure in place. Second thing is whether there's a quite a robust internal policies on transfer pricing, arm's length principle, and also legal documentation can be a challenge if a company hasn't really implement this kind of a cross-border sweeping structure. Normally, we're talking about 3 to 6 months for this kind of a structure, so it's not that cumbersome.
Okay. Lewis, another one probably for you. Someone's asking, could we use Singapore and not Hong Kong?
Yes.
Okay. Easy answer.
Yeah.
Moving on. This one is back to you, Julian. Does Johnson Matthey handle interest calculations, etc., on loans created by sweeping, or does the bank do that?
Both, actually. So the cross-border sweep we do, and the reason we do that is because we're getting those daily MT940s with the transfers recorded on them, and then in our treasury management system we automate that to a coding to an intercompany loan account. The interest calculations between the cash pool participants within China, HSBC do on our behalf, and we get that information at the end of each month.
Okay. One or two before we wrap up. Lewis, this is probably for you. Does it mean more freedom if you're already in the Shanghai free trade zone, or do you have to add another entity?
If you have presence in Shanghai free trade zone, certainly you can take advantage of more flexible, incoming flows, especially because outgoing is all the same. But potentially a challenge is whether a company will be really comfortable to use a small company, because normally the company in Shanghai free trade zone, mainly professional services or trading company, where the company feel comfortable use a small company to become the conduit for such a big, funding transfer between onshore and offshore.
Here's a question actually on offshore and onshore. Given CNY rates are larger than CNH, why bother?
Well, at this moment, right? First of all, I think look at what kind of objective a company want to achieve. If you look at the funding side, funding means financing cost. Right now, the same age funding costs are much lower than the onshore cost. I think we can confidently say there's still like 150 basis point difference between the offshore and onshore market. If we say exchange rate on a particular time, then because offshore is a completely free market where China still have the trading band range, then it might happen both ways.
Okay.
Sometimes using RMB for cross-border settlement can be more beneficial for cross-border trade, but sometimes the other way around. So it's completely market driven. But purely on the funding side, this is still the exciting part. Offshore funding costs should, in most of the cases, be cheaper than the onshore funding costs.
Okay.
So two-way sweeping, that's the traction for two-way sweeping.
Okay. And does pooling raise tax questions in China?
For cross-border sweeping, yes. Essentially, when the onshore entity is lending from onshore to offshore, meaning they're going to receive interest income, that interest income will be subject to business tax. The other way around, offshore company may also have corporate income tax, and the onshore company, when they are borrowing from offshore into China, there's a withholding tax component. But these are quite a clear tax treatments for this kind of physical funds movement.
Last but not least, because I think we are running out of time, and this is a question actually I previously had and had to dig around and find the answer. Do pool members have to be related?
For this nationwide policy and also Shanghai Free Trade Zone, yes, but not as a direct shareholding relationship. As long as on the off chart you can show the ultimate shareholding relationship, even at the top level, that's fine.
So there can be one or two companies removed.
Or multiple, as long as they belong to the same group.
So that's exactly what I found out. Had to belong to the same group.
That's right.
Excellent. Okay, I think the time has come to wrap up. I hope our webinar has brought you up the learning curve somewhat with regards to the renminbi. I think these presentations certainly have shown me there's still much to learn. My thanks to our presenters, Lewis and Julian, and to HSBC for their sponsorship. Thank you to everyone who joined today's session. I'm sorry if we didn't reach your question within our allotted time, but they were coming in very fast. As I mentioned at the start, we will be putting up a recording of this webinar on the ACT website along with the presentation in 2 days' time, and we will be sending you all the link to that. Looking forward to the rest of the year, we have a full program of conferences and events, with some of them shown here. Notably, we've got our cash management conference, which is next week, and we've got the ACT Europe conference in Germany in early March. So thank you once again for listening. If you can spare a moment to provide some feedback on the webinar, we would be very grateful. Just select the feedback widget in red from the bottom bar. The facility to do this will remain open for a short while after the webinar ends. So from all of us here, thank you and goodbye.